So, a nuclear deal was signed, and within 72 hours, the global economy started breaking. Not because of the war, not because of a new sanction, because of the deal itself. Now, the headlines are calling this a diplomatic victory, a step toward peace, a historic moment for non-proliferation. Maybe. Some of that is true. But here is what the headlines are not telling you. The terms buried inside this Memorandum of Understanding, the fine print nobody read on air, triggered a chain reaction. One that is now moving simultaneously through oil markets, bond markets, currency reserves, and the food supply chain. And the countries absorbing the shock first? Not Iran, not the United States. The countries whose stability this deal was supposed to protect. In this analysis, I'm going to show you exactly what happened, what the deal actually says, why it broke things it wasn't designed to break, and, most importantly, who saw this coming, and who positioned themselves to profit from it, because somebody always does. With that said, let's get into it. I'm David Whitmore, Chief International Analyst at Global Insight News. Hope you're doing well. Come for the geopolitics, and stay for the economic earthquake nobody named yet. To understand why this deal broke things, you first have to understand what was already cracked. For months before the signing, the Strait of Hormuz had been closed, or effectively closed. That strait handles roughly 20% of the world's daily oil supply. 20%. That's 1 barrel in 5, every single day. And every day it stayed closed, the world was quietly drawing down its emergency reserves to compensate. Central banks were managing the paper markets. Governments were releasing strategic petroleum stockpiles. And traders, we now know, were actively suppressing the paper price of oil to keep markets calm. Even as the real price of a physical barrel delivered to a real refinery on a real ship was already trading $30 to $40 above what your screen was showing you. That gap between the official price and the real price, the largest ever recorded in history. So when the Iran-US deal was announced, the market exhaled. Stocks went up. Oil futures went down. The narrative was, the war is ending, the strait will reopen, everything goes back to normal. But here's what the market missed. A deal that reopens the Strait of Hormuz doesn't fix the damage done while it was closed. Think about what 6 weeks of disrupted supply actually means in the real economy. It means fertilizer prices are already up, and that increase hasn't hit your grocery store yet. It means shipping insurance rates are at multi-decade highs. It means the countries that depleted their emergency reserves to survive the closure now have to rebuild those reserves by buying oil on a market that is still structurally undersupplied. Reopening the strait doesn't unwind any of that. It just means the physical crisis becomes visible, instead of being managed in the dark. And that is the first paradox at the heart of this deal. The announcement of peace triggered the beginning of the economic reckoning that the war itself had been delaying. Now let's talk about what's actually in this Memorandum of Understanding, because I've read it, and there are 5 things in that text that the financial press has almost completely ignored. First, the sanctions. The text commits the United States to lifting, and I'm quoting here, all types of sanctions against the Islamic Republic. Not some, not gradually, all types, including UN Security Council sanctions, IAEA sanctions, and the full stack of US unilateral sanctions, primary and secondary. Now, on paper, that sounds like a gift to Tehran, and it is. But what it also means is that somewhere between $20 and $30 billion of frozen Iranian assets are about to re-enter global financial circulation simultaneously in a market that is already under severe liquidity stress. That's not a relief valve. That's a pressure surge into a system that has cracks. Second, the oil. The deal authorizes immediate U.S. Treasury waivers for Iranian crude oil exports. No waiting for a final agreement. No phase-in. immediate. What that means is several million barrels per day of Iranian crude are about to come back online into a market where OPEC has already been cutting production, where Gulf states are bleeding reserves, and where refinery capacity in Europe and Asia has been restructuring around the assumption that Iranian oil stays off the market. Flooding that market with Iranian supply doesn't lower prices in a clean straight line. It creates winners and losers, fast. The winners are obvious. China, which had been buying Iranian oil at a heavy discount, now has to pay market price or find a new discount somewhere else. The losers are less obvious. Gulf producers, Saudi Arabia, the UAE, who need oil above $100 a barrel just to cover government spending. Returning Iranian supply pushes that price down, below their break-even point, which is exactly why the UAE had already been making phone calls to Beijing before the ink was dry. Third, the nuclear program. The deal does not dismantle Iran's nuclear program. I want to be precise about this because the language matters. The text says Iran commits to maintaining the current status quo of its nuclear program until a final agreement is concluded. Current status quo. That means an Iran that has enriched uranium to 60%, just below the 90% weapons-grade threshold. An Iran sitting on enough enriched material to build several devices in a matter of weeks. Frozen. Not rolled back. Frozen. Now, the administration will tell you this is temporary, that the final deal, to be negotiated in the next 60 days, will go further, maybe. But 60 days is a very tight window to resolve a dispute that has been running for 45 years. Fourth, the verification mechanism. The deal calls for a monitoring body without specifying what it looks like, who runs it, or what happens when it finds something it doesn't like. The details are, quote, to be mutually agreed upon. In diplomatic language, to be mutually agreed upon means we disagreed on this, and we decided not to put the disagreement in writing. The most contested site, the underground complexes at Fordow and Natanz, are not explicitly addressed in the text. And fifth, the clause nobody is talking about. In the final hours of negotiation, Iran added language affirming Iranian Omani sovereignty over the Strait of Hormuz, with the explicit possibility of imposing maritime service fees on commercial traffic. That clause was not in the original draft. Tehran added it at the last minute. Washington accepted it. And what it means in practical terms is that Iran now has a legal mechanism to tax 20% of the world's oil supply, not militarily, contractually. That is not a peace clause. That is a revenue clause dressed up as a peace clause. Now let me explain why all 5 of those elements together produced an economic shock that the signing ceremony was supposed to prevent. Start with the bond markets. The United States Treasury has to refinance or find new buyers for roughly $8 trillion in bonds over the next 12 months. $8 trillion. That is not a typo. For that to happen at manageable interest rates, 2 things need to be true. Inflation has to be going down, and the world has to trust the US enough to keep buying its debt. This deal undermines both of those conditions simultaneously. How? Because the return of Iranian oil to global markets doesn't stabilize energy prices. It creates uncertainty. And uncertainty in commodity markets is inflationary. Investors don't know how fast Iranian supply comes back. They don't know how Gulf producers respond. They don't know what the maritime fees on Hormuz will actually be. So they demand a premium to hold US bonds. That premium shows up as higher yields. Higher yields mean higher borrowing costs for everything: mortgages, car loans, corporate debt, government spending. Now here's where it gets interesting. The Fed's whole plan, under Kevin Warsh, was to lower short-term rates, steepen the yield curve, let banks borrow cheap and lend long, and quietly recycle that spread back into Treasury purchases. without anyone calling it money printing. That plan requires short-term rates going down, commodity inflation going down, and the bond market staying calm. The Iran deal produced the opposite of all three. Short-term inflation expectations went up, bond yields moved higher, the dollar got more volatile. So the deal that was supposed to create economic stability created economic noise, exactly at the moment the system had the least capacity to absorb it. Now let's talk about the Gulf. Saudi Arabia needs oil at roughly $100 a barrel to cover its government spending. Before the war, it was exporting close to 7 million barrels a day. Since Hormuz closed, that number collapsed. Saudi Arabia has been borrowing, externally, at a rate never seen in its entire history. And the Iran deal doesn't fix that, because the deal returns Iranian supply to the market, which pushes the price toward $80, maybe $75, below the Saudi break-even. Which is why the Gulf states, the UAE specifically, went to Beijing before the deal was even finalized. They signed 24 separate trade and investment agreements with China. They threatened to price oil in yuan. They told Washington, give us a dollar swap line or we start selling U.S. assets. And Washington gave them the swap line. Let me put that in plain terms. The United States Treasury just confirmed in Senate testimony that Gulf states hold enough American assets that if they sold them, it would destabilize U.S. markets. The country that sanctions everyone just admitted it can be sanctioned through asset sales. That is a structural shift in global power. And it happened in the same week as the Iran deal. Not a coincidence. Now here's where we pull back and look at the bigger picture. Because what we're watching right now is not really America versus Iran. It's not really a nuclear negotiation. What we're watching is a civil war inside the profit machine itself. Three factions, same system, different business models, and they want opposite things. Faction 1, the old model, the military-industrial complex, defense contractors, weapons lobbies, the old guard of Washington foreign policy. Their business model requires instability. War generates weapons contracts. Destroyed cities generate reconstruction deals. Every ceasefire is a threat to their revenue. Every peace agreement is a market correction for their stocks. They need the Iran conflict to continue, not necessarily to escalate, but to simmer permanently. Faction 2, the new model. The technological industrial complex. Silicon Valley, AI infrastructure investors, the Gulf sovereign wealth funds that need to deploy trillions into something other than oil futures. Their business model requires stability. You cannot build a trillion-dollar AI grid on a planet that's always on fire. Data centers need reliable power. Supply chains need open shipping lanes. Investors need predictable energy costs. They need the Iran conflict to end. Not because they care about peace, but because war is bad for their infrastructure build-out. And Faction 3, the one most people miss, is China. China doesn't need the Iran conflict to end, and it doesn't need it to continue. What China needs is for the conflict to last exactly long enough to extract maximum concessions from a United States that is running low on missiles, running low on oil reserves, and running low on bond market credibility. And here's what's remarkable. China has been buying gold, not quietly, aggressively, while simultaneously signing yuan-denominated commodity deals with Gulf states, building alternative payment rails to SWIFT, and watching the U.S. beg Gulf allies to not sell their Treasury holdings. There is a rule that has held true throughout most of recorded history. The country exporting its gold is the one losing. Right now, the single largest export out of the United States, bigger than oil, bigger than aircraft, is physical gold, leaving America, going to China. That is not a coincidence. That is a monetary transition happening in real time. So let me say the thing that the mainstream analysis is missing. The Iran nuclear deal, as structured, is not primarily a nuclear agreement. It is a financial instrument. Think about what it actually does in practice. It releases tens of billions of dollars in frozen Iranian assets into global circulation simultaneously with no phase-in. It reopens Iranian oil exports before a final agreement is signed, creating immediate supply-side pressure on Gulf producers who are Washington's key creditors. It adds a Hormuz sovereignty clause, giving Tehran a legal mechanism to tax global oil flow.
How to make
And it
team
freezes
handoffs
the nuclear
smoother
program
in large AEC
without rolling it
projects.
back, leaving
1.
Iran's leverage
Keep drawings
fully
and models
intact
in one
for the
shared
next round of
workspace.
negotiations.
2.
Now ask
Use
yourself,
cloud comments
who
instead of
benefits
long
from that
email threads.
specific combination of
3.
outcomes?
Assign
Not the Gulf
tasks
states.
directly inside
They're
your
bleeding.
collaboration tool.
Not the U.S. bond
With
market. It's
BIM
under
EDTA,
pressure.
all
Not
3
Israel.
steps happen in
It
one
wasn't
place.
consulted.
It's that simple.
The beneficiaries
Join the
of
platform
this
at
exact deal structure, as written, are the parties who hold
chat.bim.edta.net/register.
Iranian assets, who trade in commodities priced outside the dollar system, and who have been quietly building the alternative financial infrastructure that becomes more necessary every time the US dollar loses credibility. I'm not saying this was planned that way, but I am saying follow the incentives. They rarely lie. So, who wins from this deal? Iran wins economically, immediately. Assets unfrozen, oil flowing, rial recovering, sanctions narrative broken, all before a final deal is signed. Their chief negotiator called this confirmation of American failure. And domestically, for a regime under pressure, that framing is worth more than the money. Trump wins politically. He got a signing. He can call it the deal of the century. He avoided an escalation that could have unraveled his economic agenda entirely. The market rewarded him, briefly. He'll take it. China wins structurally. Every day this process drags on, China's alternatives to the dollar-based system look more credible. Every dollar of gold that leaves Fort Knox and arrives in Beijing makes the next negotiation harder for Washington to win. And the losers? Saudi Arabia and the Gulf, whose oil revenues are now structurally challenged by Iranian supply returning to market. Israel, which was not consulted, launched an airstrike on Beirut the same night the deal was announced, and is now diplomatically isolated in a way that has no recent precedent. And the American middle class, whose grocery bills, gas prices, and mortgage rates will reflect the inflationary noise created by this deal long after the signing ceremony has been forgotten. Inflation is always how unpayable debt gets paid. Not by governments admitting it, by the price of eggs going up. That mechanism is running, right now. The deal is signed. The nuclear program is frozen, not ended. The economy was supposed to stabilize, and instead absorbed a shock. The peace was announced, Tdabe, Pateto, and the war inside the profit machine continued. Here's the only question that matters now. The next 60 days of negotiations will determine whether this Memorandum of Understanding becomes a real agreement or becomes one more document in a very long stack of promises that the world made and then quietly abandoned. Mekadebe. Watch the bond markets. Watch the gold price. Watch whether IAEA inspectors are granted access to Fordow. Mekadebe. Those 3 data points will tell you everything the press conference won't. Mekadebe. You can sign a deal in a day. You can't buy trust in 60.